Imagine a world where physical cash is no longer king, where every transaction you make, whether buying coffee or transferring millions across borders, is recorded, tracked, and settled digitally. This isn't the distant future, it's happening now, as governments around the world experiment with digital currencies backed by the state. These aren't cryptocurrencies like Bitcoin or Ethereum. They are centralized, government-issued digital money designed to modernize economies, enhance control, and redefine the very nature of currency itself. Today, we'll explore the rise of these government-backed digital currencies, why they matter, and the profound ways they are reshaping global finance. At the core of this movement is the concept of a central bank digital currency. Unlike traditional money, which exists in physical notes or bank account balances, central bank digital currencies are fully digital, issued and regulated by national authorities. They aim to combine the convenience of digital transactions with the stability of government-backed money. While private cryptocurrencies operate in decentralized networks with fluctuating values, central bank digital currencies promise security, legal recognition, and direct integration with national payment systems, offering governments unprecedented control over their monetary ecosystems. One of the primary motivations behind central bank digital currencies is financial inclusion. In many countries, significant portions of the population remain unbanked or underbanked, lacking access to basic financial services. Digital currencies can be accessed through smartphones or simple devices, enabling millions to participate in the formal economy. This access can reduce transaction costs, speed up payments, and bring financial tools to communities previously excluded from the system. By broadening access, governments aim to stimulate economic activity while modernizing their payment infrastructures. Another driver is payment efficiency and security. Government-backed digital currencies can facilitate instant transactions, eliminating intermediaries, reducing fraud, and improving transparency. Cross-border payments, traditionally slow and expensive due to banking networks, currency conversion could be streamlined through central bank digital currencies. In addition, digital currencies reduce the risk of counterfeiting and theft associated with physical money. This efficiency is particularly attractive in a global economy where speed, security, and traceability of transactions are critical. Central bank digital currencies also provide governments with monetary policy tools previously unavailable. By tracking digital money in real time, authorities can monitor spending patterns, enforce tax compliance, and implement targeted stimulus measures directly into citizens' wallets. For example, in times of economic slowdown, a government could deposit digital funds into accounts to boost consumption or investment. Conversely, negative interest rates could be applied directly to digital holdings, influencing spending behavior in ways impossible with cash. This level of control represents a dramatic shift in how central banks manage economies. Financial stability is another major concern addressed by central bank digital currencies. During crisis, traditional banking systems can face liquidity shortages, bank runs, or payment bottlenecks. A government-backed digital currency offers a secure alternative, ensuring citizens have access to safe, reliable money. In addition, central banks can better monitor systemic risks, detect early signs of instability, and deploy interventions more effectively. Central bank digital currencies can therefore act as both a tool for growth and a safeguard against financial shocks, strengthening overall economic resilience. Privacy and surveillance are significant considerations. While central bank digital currencies promise efficiency, they also create unprecedented visibility into transactions. Governments could, in theory, track every purchase and transfer, raising questions about civil liberties and personal privacy. To address these concerns, some designs propose partial anonymity, tiered privacy, or encrypted transactions. However, the balance between transparency and privacy remains a central debate in the development of digital currencies, highlighting the trade-offs inherent in state-controlled monetary innovation. Global competition is accelerating the adoption of central bank digital currencies. Countries like China have already piloted the digital yuan, integrating it into retail, transportation, and e-commerce systems. Other nations, from Sweden to the Bahamas, have launched or are testing digital currency initiatives. The United States and European Union are exploring central bank digital currency frameworks to maintain their position in global finance. This race is not just about convenience, it's about maintaining economic influence currency sovereignty, and strategic leverage in a world increasingly dominated by digital transactions. Central bank digital currencies also intersect with cross-border trade and geopolitics. Digital currencies can reduce dependency on dominant foreign currencies for international transactions, allowing nations to settle trade directly using state-issued digital money. This could shift global financial balances, reduce reliance on traditional reserve currencies, and enhance economic independence. Countries adopting digital currencies effectively can influence global trade standards, payment networks, and financial norms, creating a new layer of economic strategy and diplomacy. Banking models themselves are evolving in response to central bank digital currencies. Commercial banks may face disintermediation, as citizens hold digital currency directly with central banks. This could reduce banks' traditional deposit bases, prompting them to adapt by offering new financial services or integrating with government-backed digital frameworks. At the same time, banks may act as intermediaries for distribution, onboarding, and customer support, creating hybrid models where traditional banking and digital currency coexist. The financial ecosystem is therefore undergoing a profound transformation. Technological infrastructure underpins the viability of digital currencies. Blockchain and distributed ledger technologies allow for secure, transparent, and immutable transactions, while centralized ledgers provide scalability and government oversight. Advanced cryptography ensures integrity, while digital wallets, mobile apps, and online platforms facilitate widespread adoption. Governments are investing heavily in building resilient, scalable, and secure systems capable of handling millions or even billions of transactions daily, emphasizing the critical interplay of technology and policy. Central bank digital currencies also present opportunities for innovation in financial services. Programmable money, smart contracts, and automated payments could reshape industries from e-commerce to public services. Governments could embed conditional transfers, subsidies, or incentives directly in digital wallets, creating precise, measurable, and immediate economic interventions. Businesses can streamline payroll, taxation, and supply chain payments, leveraging digital currency infrastructure for efficiency and cost reduction. The potential for creative applications expands far beyond traditional monetary systems. Risks remain significant. Cybersecurity threats, technical failures, and operational errors could disrupt economies. Centralized digital systems may become targets for cyber attacks, exposing vulnerabilities in national financial infrastructures. In addition, rapid adoption could create transitional challenges for citizens, businesses, and governments alike. Educating the public, building trust, and ensuring interoperability with existing financial systems are essential for avoiding disruption and fostering confidence in digital currencies. Economic inclusion is intertwined with financial literacy. While central bank digital currencies promise broad access, citizens must understand digital wallets, transaction processes, and security measures. Governments and institutions face the challenge of educating populations, particularly in regions with low technological penetration or high skepticism toward formal financial systems. Adoption is not only a technical issue, it is a social and educational one, requiring trust, understanding, and user-friendly design to achieve meaningful economic impact. Environmental impact is another consideration. While digital currencies reduce the need for physical cash, their technological infrastructure, particularly blockchain-based systems, consumes energy. Governments are exploring energy-efficient solutions, consensus mechanisms, and infrastructure optimization to minimize environmental footprint while maintaining security and scalability. Balancing innovation with sustainability is an emerging challenge in the rise of digital currencies. Government-backed digital currencies are transforming the financial landscape. They promise faster payments, financial inclusion, enhanced monetary policy tools, and economic resilience. Yet they also raise concerns about privacy, cybersecurity, banking models, and social adaptation. Central bank digital currencies are not simply a technological upgrade, they are a fundamental rethinking of money, finance, and economic governance. Their rise marks a pivotal moment in the evolution of global economies, offering both opportunities and challenges for citizens, businesses, and nations. The next time you transfer money, pay for goods, or invest in digital assets, remember, the world of currency is changing. Cash is no longer the default, and government-backed digital currencies are quietly reshaping how value flows, who controls money, and how economies function on a global scale. The rise of central bank digital currencies is not a distant future, it is a revolution unfolding in real time, and understanding it is essential for navigating the economic realities of tomorrow.